Hello, everybody, and welcome to the Quant Investing Investment Webinar Series. In this webinar, I'm going to talk to you about how we select investment ideas for the Quant Value newsletter. As I may have said, my name is Tim Dutoy, and let's move on to the first slide, where I'm going to tell you exactly what I'm going to be talking about today. I'm going to talk to you about what investment strategies we use, what happens after we have a list of companies, how to make sure that a company is not wrongly included in the screener. You'll see that happens sometimes, and it's not something that can be avoided. And then I'm going to tell you about the 22-point checklist we use to find bad companies, and why you must always check the latest company news before you start doing serious research on a company. It'll save you a lot of time and effort. And then the last slide I'm going to talk to you about is, last but not least, it's very important how to not let your biases, we all have them, I'll tell you about mine, let you ignore great investments. And then afterwards, we'll have time for questions and answers. If you have any questions during the presentation, simply type them in, and after the presentation, I will take them on a first come, first serve basis and answer your questions. Anyway, so on to the first slide. What strategies do we use to select investments? I use the QI value indicator that we developed. It is an indicator that we developed based on all the best testing of investment ideas and strategies, also back testing, that we found over the more than 25 years that we've been investing. It's basically a valuation indicator that uses 3 different valuation indicators, 2 pre-tax profit indicators on enterprise value, different numbers, of course. We also use free cash flow to enterprise value, and then we use a liquidity indicator to help you identify stocks that may be ignored by the market, that don't trade as much, traded value compared to profits. It's a very interesting indicator, and you'll see that I highlighted, or I included hyperlinks in the presentation. If you don't have the presentation yet, then afterwards I'll send you an email where you can download it. And if you click on the hyperlink, you can go to an article that'll tell you a lot more information about that. And then secondly, we use the Petrovsky F-score to identify companies with improving financials. A friend of mine very correctly described the Petrovsky F-score as a score you can use to find companies with good fundamental momentum. In other words, increasing profits, increasing sales. You'll see that I also included a hyperlink to that item where you can click and you'll find a detailed article that explains the Petrovsky F-score in greater detail. And then we use 2 different momentum indicators. We don't use them together, of course. We use them, the one, and then we use the other. Even though they come up with quite a lot of the same companies, there's a few different companies that come up which are always interesting to look at. The first one is price index 6 months. That basically helps you find companies that have met the previous 2 criteria, QI value and the Petrovsky F-score, that have gone up the most over the past 6 months. The second indicator, called adjusted slope, 125-day, 250-day average, is a longer-term momentum indicator. But the nice thing about the adjusted slope is that it screens out companies that have had a jump in their share price. For example, if you were looking at a company that has increased its share price over the past year or so, and the company's share price jumped because of a takeover offer, that's not really the company that you're looking for. The company that we're looking for with this indicator is a company that has had a smooth, upwardly moving share price. So these are the criteria we use to identify the companies we would like to invest in. But now, the screener obviously comes up with a list of companies. How do you refine this list of companies further? We do it for the newsletter with a 22-point checklist that we work through for every company. It's basically the 80-20 principle of identifying bad companies, or at least identifying companies where you need to do a little bit more research before you can feel comfortable in buying them. Let me just explain about the checklist. As we don't have a strict rule that if a company fails any amount of these items that we throw it out. This is simply a list that we go through to identify possible problem areas and areas where where we need to do a little bit more research on the company. I'll go through a few items. We don't have time to go through all of them, but they're quite self-explanatory. The third item on the left-hand column you'll see is called operating cash flow. Is it greater than net income? This is a very important measure because operating cash flow, because it doesn't include depreciation that net income does, it should always be greater than net income. The times when it's not greater than net income is when the company is making accounting profits but not cash profits, and that's definitely something you want to have a look at. The next item is the free cash flow per share higher than dividends per share? If this is not the case, then it means that the company is paying dividends not out of profits, but either out of accumulated cash or it's taking on debt to pay out dividends. In either case, it's not a good sign because it means that the dividend is not sustainable. So that's something you want to have a look at. And then further down on the left-hand column, there's what at first glance may seem like a stupid question. It says, does the cash belong to the company? Now, I never really thought about this until a few years ago. I looked at a lot of online gambling companies. And what happened to these companies, they had customer deposits, because obviously a customer has got to deposit money with the online gambling company before they can start betting. But the companies booked this cash all as cash belonging to the company, which means if you look at enterprise value, which deducts cash from the company's valuation, these companies are all going to look too cheap. Whereas if you remove the cash from their balance sheet, then the valuation is going to look substantially different. So it's a question to ask. I mean, most of the cases, the cash does belong to the company, in any industrial company, for example. But for certain companies, it's definitely a good question to ask yourself. Then if you look on the second column, fourth item is the tax rate plausible, around 35%? That's the, say, average tax rate in most developed countries for companies. You know, if it's around 25%, I would say that's also still fine. But if a company has a negative tax rate because of tax rebates, or a really low tax rate, 4%, for example, you want to make sure that that is sustainable, because otherwise net profits in the next year or on the year thereafter is going to decline substantially when the company returns to, paying a normal tax rate of 35%. And then the second to last item, has there been any net share buybacks? This is a very important indicator, as it helps future returns, because net share buybacks have been proven to increase market outperformance of most companies. Anyway, so this is the list we go through. As I said, these are only items to research further, and it's not items that will, say if a company fails 4 of them, then we'll throw the company out of the screener and we won't look at it further. How to make sure that a company is not included in the screener by mistake. This, let me just explain the principle. The screener makes use of historical financial data, the most up-to-date financial reports of the company, of course, but it looks at the current share price. So what you want to do is you want to make sure that in the historical profits that the screener looks at to value the company, there are not any items that make the profits look higher than they would normally be. 2 items, for example, is a large off sale. This happened to a lot of media companies during the Olympic Games. Around the Olympic Games, these companies were able to sell a lot of advertising, which increased their income substantially, but this was not an item that could be repeated afterwards. Also, if the company sold a business or had a substantial profit on the sale of a property, these items are not going to be sustainable. So the company may look cheap if it's in the screener, but if the earnings return to its normal level, then it's not going to look nearly as cheap as it is looking at the moment. It's easy to find these ones if you look at any one of the financial portals, Yahoo Finance or whatever. You'll see that the last year or the trading 12 months of earnings looks like a record amount. And if these are there, you obviously want to go have a look, dig through the financial statements to see if it's a one-off or if the company's really substantially increased its profitability. Why to always check the latest news on the company? Remember, as I said, the screener looks at the last financial reports compared to the current share price. And if anything happened in between that period, which for some companies that don't file quarterly reports may be up to half a year, then there's a big chance that the company may not still be the same company that you're looking at according to the financial data. Let me give you a few examples. After the last financial results, the company's either sold a business, which means that its profits may look substantially different in future. It's either spun off a business, which means there's a part of the company's gone. The existing shareholders have already received shares in the new company, and the shares obviously traded down of the company you're looking at. Or the company paid a special dividend. If between that period the company paid a special dividend, the share price usually drops by that amount because the cash is off the balance sheet and the shareholders already received that dividend. This means that the share price would have dropped substantially, but you're looking at old financial data, so the company may appear cheap, but it isn't anymore. This information is usually very easy to find. You can simply go to the investor relations website of the company, look under press releases or media releases or something similar to that, and just look at the press releases of the last year. And if you see any of these items, then it's obviously a bit of a warning sign that you should go and have a further look at the company to see that it's correctly included on the screener. Because if it is any of these things happen, then you must just ignore the company and not research it any further. How to avoid your biases. This is a thing that we all have, and I've paid a lot of attention to this in the past. I love asset management companies and software companies, mainly because I've made a lot of money on them in the past. And I hate gold mining companies or even mining companies in general. This is simply because when I started investing more than 25 years ago, I lost a lot of money on gold mining companies. And ever since that, it's been something that I would like to avoid if I can. But to counter my biases, I've got a simple rule that there must be a really good reason before I exclude a company. If it's one of the reasons that I mentioned before, that either the company had record profits or something happened to the company in the meantime, then that's a good reason to exclude the company, of course. Or if any of those items on the checklist look really negative, then that's a good reason to exclude. But apart from that, I do my best to not exclude these companies at all. Why exclude biases, you may be thinking? Well, the thing is, if you have a good system that's been proven in up and down markets that gives you market-beating returns over the long term, if you second guess this system, it will only give you lower returns. Let me give you an example. In 2000, a lot of researchers did a lot of studies on 136 different studies where they compared a mechanical system to experts making decisions. And in 94% of the cases, they found that experts lowered or had the same return. Sorry, the system had in 94% of the cases the same return or a higher return than what the experts had. Only in 6% of the time did the experts make a better decision than these mechanical systems. And then the expert had more information. They didn't test that any further, but it's highly likely that if these systems had the more information that the experts had access to, that it also would have made better decisions than the experts. So simple rule is, if you interfere in a really good system, you will most likely only lower the returns of that system. Before we go to questions, just a summary of what I've quickly gone through in this webinar. If you follow a good strategy, you make sure that the company is correctly included on the screener. So in other words, no record earnings or anything. You look at the latest news to see that nothing has changed in the meantime. And you keep your biases out of the equation. You can't have anything else but have really good returns. That's the end of this webinar, and I will now take any questions you may have. If you have any questions, simply type them into the chat box, and I will take them on a first-come, first-served basis. For some reason, I'm not seeing any of the questions here. I don't know what's going on. I have a question here from Philip, and he says, he asked the question is, do I use the Benish M score? No, I don't use the Benish M score. It's an indicator that we have in the screener, but it's not something that I specifically use to select companies for the screener. We have another question. Sorry, we have a question from Nadir. The adjusted slope does, that's the momentum indicator that does use the R square indicator, Nadir. That's correct, yes. And we have another question from Philip, where he asked, do we use anything else beside the company website? I have a subscription to the Financial Times, and I use that all the time. They've got very, very reliable data. It's quite expensive, though. There are other sources, good sources of information. For example, the Wall Street Journal has got really good longer term, I think 5 or even 10 years financial data on a lot of companies. And so that's another one that's also available for free. And then Yahoo Finance is also very good for US companies, I think. Morningstar.com is another source that you can have a look at. Torsten, I see that you asked a question, how do I reduce the usually large amount of companies that deliver any system? In the case of the screener, I sort these companies by QI value. The QI value, the lower the value is, the cheaper the company is. And when I've selected all of these companies, I sort them by QI value to get the cheapest companies in the system, or in the screen rather. Is there any other questions? Oh, Torsten, I understand. Yeah, I understood your question correctly. Yes. So just maybe to expand on that, I set the parameters up for all three of those, for the QI value, the F score, and the 20% of companies with the best momentum indicator. And then of that list of companies, I sort them by QI value. And then I see Samir asked a question, is there an efficient way to eliminate companies with outlier earnings from screen, or is it the only way to look at their long-term earnings? Samir, there's unfortunately no way to do that, because the screener looks at the trailing 12 months of data, which obviously we try to do so we get the most up-to-date financial results in the screener. And except to possibly screen, but we've looked at that to screen and see if there's an outlier value and then throw out those companies. I don't think there's any way to do it. If we do program that and say, for example, there is a company with a big jump in profitability, then the screener will screen that out again, and that's not what you want. So unfortunately, there's no real good way that we've found to do that. The best way is just to quickly look at the company's financial results and see if there's an abnormal, a record year or a record trading 12 months, and then work with that. And then, see, either throw the company out or quickly have a quick look in the presentation of the last results to see if there was a one-off type of income statement item. I know it's a bit tedious, but unfortunately, that's one of the things we can't ignore. That's something we thought about a lot. Any other questions? Anthony asked if we've applied our strategies to short the market. No, Anthony, I'm not a short seller at all. I've been thinking about it a lot, but this idea of limited profit and unlimited liability, and I looked at all those investors getting burnt with that Volkswagen story when that Volkswagen stock price went through the roof because of a short squeeze. It's just something that I haven't looked at it. But if you look on the website, look on the blog post, I've wrote an article about all the indicators we have available for people that do short selling. Nadir asked a question, does value versus growth companies, do I apply the same rule? Nadir, I'm not a growth investor. Not at all. I try to find undervalued companies with good share price momentum. So I'd rather try to look for a company that is cheap but moving up in share price. I'm not really a super deep value investor. So you can say that it's a little bit of both, but I don't like growth companies that are overvalued. I'd rather buy a company where the share price moving up that is relatively undervalued compared to the market and that. So I think the rules for growth companies, you'll probably there use less of an undervalued search, maybe make the QI value wider, and then look for companies with the best momentum in terms of that. That's my best suggestion, but I'm not a growth momentum or a growth type investor just because I don't like the big falls that go with those companies, Does that answer your question? Any other questions that you may have? Okay, then I'd like to wrap the webinar up. Thanks, everybody. Thanks so much, everybody, for attending. I'm going to send you an email shortly with a page where you can download the presentation, so you can click on the hyperlinks, and also on a YouTube recording of the webinar where you can access it again. So look for that in your inbox shortly. Thank you very much. Bye-bye.